to this week's episode of Coinscrum Markets. I'm Teana Baker-Taylor. Coming up, we speak with Toby Lewis from Novum Insights. He's joining me to take a look at their research into crypto funds. Cointelegraph's Demelza takes us through their latest research report. And I also speak with Stephen Pally from Anderson Kill to break down the CFTC and Bitmex saga. But first, let's take a look at this week's blockchain industry news. With China announcing the latest steps in its live rollout of the digital yuan this week, the Bank of International Settlements, the body which central banks cooperate, also released a joint report with its members that attempts to lay down the foundational principles by which central bank issued digital currencies should operate as the race towards digitized fiat hots up. It would seem that central banks aren't alone in changing their tune. JP Morgan's CEO Jamie Dimon, who has vocally dismissed Bitcoin many times over the years, commented on last week's $50 million Bitcoin investment by Jack Dorsey Square, saying it's a strong vote of confidence for the cryptocurrency. And with news of institutional Bitcoin adoption spreading faster than a pandemic, this week's spot was grabbed by Stone Ridge when the established asset manager with $10 billion of AUM announced its own $115 million bet on a leading crypto. Although it may have stopped just a bit to take a breather, DeFi's definitely not gone away, with the hot money still rolling in. Aave, a leading decentralized borrowing and lending platform, has raised $25 million from Blockchain Capital and Blockchain.com, amongst others, to help bring DeFi closer to institutional use, according to their founder, Stani Kulichov. And finally, in a sign that the once convoluted process of trading crypto is starting to ease up, Gemini, the exchange founded by the Winklevoss twins, has partnered with the UK's BCB group to offer UK users a faster and simpler way to send and receive GBP by utilizing BCB's proprietary DLT-based Blink network. That's it for the news this week. Please remember to subscribe to our channel. Next up, Crypto RFQ. It's a pleasure to be joined today by Toby Lewis, CEO of Novum Insights. Toby, thank you so much for joining us.
Hi, Teana. It's great to be here as well. So thanks for having me here at Coinscrum.
Absolutely. It's a pleasure. So we're going to take a look at some of the research you've been doing on crypto funds and hedge funds. But before we start, for those in our audience that might not appreciate the nuance between the two of them, can you just clarify the difference in what you classify as a crypto fund and a crypto hedge fund?
Yeah, so I think the essentially our data has been looking at the sort of wider crypto fund universe. So anyone trading or doing particular forms of investment in crypto funds. A hedge fund specifically, you're typically talking about a group that's doing investments where there's some form of hedge, literally. So where they're looking to try investments on both sides, and so that's essentially the difference. So in some ways they're often used interchangeably by people in the industry, but I think the better terminology is crypto funds, because a lot of groups aren't really doing hedging. They may be doing some form of alternative strategy, although there are some that are doing it. So it's more, and a lot of the crypto funds are actually characterized by almost quasi venture capital style strategies. So if you look at the likes of Polychain or Digital Currency Group or Pantera, they are deploying some hedging strategies, but some of the stuff that they're doing is just simply buying new issues. But each group has various different forms of strategies to get their returns.
Okay, so let's dig into some of the data a little bit. What have you found with regard to crypto hedge funds? How many of them are there out there? And what's their geographic distribution?
So there's roughly 300 hedge funds and sort of crypto funds, and half of those are more or less in the US, which is kind of unsurprising in terms of capital markets. Although there is a tricky regulatory environment for those groups to be operating in the US as well. You can see the great sort of geographical spread that goes all across the world, really. And I think obviously, I think the returns have been very intriguing. The 2018 market was quite a tricky market for the crypto fund market. The quantitative funds ended up slightly up on average in that year. That's PwC data. But then the most funds took significant losses in 2018. But then they rallied back hard in 2019, and I think a lot of groups are finding best practices. I'd say crypto funds are kind of like fireflies at the moment. Their lifespan can be pretty short sometimes. I mean, I've seen many super smart groups come and go over the years, so their life sizes can be 2-3 years. But I think what we're seeing now is the building blocks of groups with bigger assets under management that have stayed the course through various cycles.
Okay, so how are these funds broadly participating in the market across the different assets?
Yeah, so perhaps unsurprisingly, BTC is the biggest market, and then sort of it goes down across your. I think the funds generally are looking for institutional appeal, so often trying to allocate heavily towards the major traded cryptos, the ones with liquidity, the ones that they won't get into because they're needing to put together legal prospectuses and these kind of things. If they are going after more exotic cryptos, they will need to be relatively clear and have a small basket. So they can go fairly far and wide, but the portfolios that you can, and you'll see the graph there, but like it'll be the larger cryptos, the BTCs, the ETH, the variants on BTC, and dipping in and out of particular assets that are most likely to have liquidity.
Okay. And across all of the funds that you've researched, how many of them are using third-party research? So
it's a small percentage at the moment are using third-party research, and I expect that to change. It's roughly in the sort of 25% range, and I think that is indicative of a fairly immature industry at the moment. Which I think will, if you look at institutional markets, those sort of players absolutely subsist and thrive on it. I think that there are certain techniques that hedge funds and crypto funds in this market are finding, and they can be very tech driven, so they might not feel they need research, but I anticipate, like, if you look at the sort of voracious consumption of research in the traditional markets, that will only go up and up.
Yeah, indeed. And I think we've always had kind of a lack of reliable data, and that's starting to improve. So, that may be an indication as well that when the data becomes more statistically relevant, then there would be more appetite to then consume said data. What about fees? What do the fee structures typically look like, and how do they compare with traditional funds?
Yeah, well, they're actually, because it's an alternative asset class, hedge funds, crypto funds in the space are able to charge much more than in traditional markets. So the old phrase of a hedge fund was 2 and 20, right? An alternative manager would want to charge a fee of 2% with 20% carry. So annual fees of 2% of the asset managed and 20% of the gains they made. The crypto funds are typically able to charge a bit above that as an average, right? If you think of that over the industry, there are some that are able to charge, and this was especially the case in 2018, 2019, people were charging 3 and 30, even more, right? So it was because they were getting pretty eye popping returns in the boom years and getting access in 2017, 2018. And these are difficult markets to trade. They're very complex. So I think there's still a bit of an edge for the managers that are able to demonstrate strong performance in terms of the fees they're able to argue for.
Fantastic.
Great.
Toby, thanks so much for joining us today and
Great.
breaking this
Right.
research down for us. With the headlines of ever larger asset managers and funds investing in Bitcoin becoming more frequent, the long-awaited institutional adoption narrative finally seems to be unfolding. This week, I spoke with Demelza, head of research at Cointelegraph, to discuss their latest research paper that analyzes the growth of institutional interest in the crypto markets. I'm delighted today to be joined by Demelza, head of research at Cointelegraph. Demelza, thank you so much for joining us today.
Thanks for having me, Teana.
No, it's great. I'm excited. We're going to talk about your latest report and institutional demand for digital assets. So why don't you just take a moment and give us a brief introduction to yourself and the Cointelegraph Research Division.
Sure. Well, I joined Cointelegraph's research department in June, and we basically produce research reports on various topics within the industry. We released one about 2 weeks ago on decentralized finance. And this report that we're publishing next week, it actually hasn't come out yet, so this is kind of like a sneak peek. This report is on institutional demand.
Great. Okay. So the latest research report you are the co-author of, it will be entitled Discovering Institutional Demand for Digital Assets. It sounds like your co-authors were Dr. Philip Stounder from the Frankfurt School Blockchain Center and Dr. Alfred Tauds from the Vienna University of Economics and Business, in partnership with a number of prominent firms in the industry. So lots of academic support, and it sounds like industry contributions. So tell us a little bit about the methodology of the paper and how this research was conducted.
Definitely. So basically, there's only one report so far that has studied institutional demand with a survey method, and that was Fidelity's research report that came out earlier this year, and they did one the year prior. The year prior, they focused on their US investors, and this year they focused on their US and European investors, and these are all investors that are already with Fidelity, that already have accounts with Fidelity. Mm-hmm. So what we wanted to do was do a study on basically a broader base of institutional investors across Europe. We're focusing on Europe. And what we did was, in Europe, every single financial market authority has a list of all the professional investors within that country. So we took the list of all the investors, we sent out a survey to each of them, and then in addition to that, in order to boost our response rate, we reached out to the local banking associations and fund associations within 4 countries within Europe, and we requested for them to send out the survey to their members. And this survey was done between June and September of 2020.
Okay. So on the institutional side, what was the typical makeup of the respondent? For example, what type of AUM are we talking about? Big, little?
So So there was two outliers that had, basically over 150 billion in assets under management that responded. But if we take out, those two outliers, if we just focus on the median assets under management was 500 million. So about $500 million was being managed by these firms. And the total assets managed by all of the 55 asset allocators that participated in the survey was over 719 billion, which is about double the current market cap of the crypto market. And the respondents in the survey are managing about 6 billion worth of crypto assets right now, which is about 2% of the entire crypto market cap.
Okay. And you mentioned that this was across with the focus on Europe. So what were the primary countries that the respondents came from?
We focused on Switzerland, Germany, Liechtenstein, and Austria. And the main reason for that is that, during the 1990s, you really had a big pull in California of talent and labor from around the world during the internet boom. Mm-hmm. And, a lot of people could point to the beneficial, kind of property rights and regulations that existed at that time to kind of help promote innovation and companies to form and capital formation. And now, we kind of see that in Switzerland, where we have Crypto Valley, we have a lot of forward-looking regulators, we have a lot of infrastructure already set up, like many, 6 or 7 banks already in Switzerland that are offering crypto bank accounts. Yeah. So we have a lot of the infrastructure there, and that region has really pulled in a lot of innovation in this field.
Okay. So let's take a look at the demand side of things. Exposure, timing of entering the market. Can you kind of give us some key insights into what demand looks like today?
So out of the people that responded to the survey, we had 36% saying that they had already invested in digital assets. So this means they either already owned them in the past or they currently own them. Mm-hmm. And the majority of them came in during 2019. So that was basically where most of them joined. A few of them came in during 2018. And also a good portion came in during 2020. So we had, pretty much the last 3 years is where a lot of the respondents had entered into the market. And we also asked them, do you plan to invest in the future, for the respondents that said they have not currently invested. And 39% said they plan to invest in the future. So actually more of the respondents said we plan to invest in the future than said they're already invested. So when you add it up, actually, the total of the professional investors that said they'd already invested or they plan to invest, it was over 61%. So a majority of the institutional investors responded saying they plan to invest in the digital asset market, which is phenomenal results.
Yeah, indeed. It's definitely trending in the right direction. We've been saying that institutions are coming for some time, and it sounds like they actually are. So how are they gaining exposure? What's the balance between potentially the spot market and futures markets? What kind of ROIs are they seeing? Like what's the activity kind of looking like when you look on average across the respondents?
Okay. So in terms of ROI, so basically we didn't ask them for specific ROIs on their crypto allocations, but what we did ask them is, what are they investing in? Are they investing in structured products? Are they investing in funds? Are they investing directly and doing custody on their own? Basically, what we found was that the majority of people wanted to invest directly. And then the second most interesting was with regulated funds, specifically alternative investment funds. Then it was the UCITS fund. So these are structures of funds within Europe. And then at the end, it was structured products, which is basically certificates, ETPs, ETNs, and then futures. So I have to say that overall, the majority of them wanted to interact with the spot market instead of the futures market.
Interesting. What did they say their main barriers to entry either had been, or what was preventing them from getting involved if they were in that 39% of respondents who hadn't yet?
So we had an interesting kind of perplexing result there. I mean, one tactic with surveys is that you ask people the same question, but in two different ways, just to kind of see if the answer stays the same.
Sure.
We asked them, what is your main obstacle? And a lot of them said regulation. But then, later on in the survey, we asked them, is it more internal policies within your company that's restricting you from investing, or like allocating some of your company's portfolio to digital assets, or is it, regulations within your country that's stopping your firm? And they said that the majority of the problem was policies within their own company that was stopping them from allocating resources, and not government regulations. So I think, either regulations from inside the firm or the government is what is the biggest barrier to a lot of people allocating more assets. And interestingly enough, it was kind of like a digital assets for me, but none for thee kind of like response, because we asked them, are you personally invested? And the majority of respondents were invested personally. It was like 56%. And then we asked them, how much control do you have within your company over allocating assets, like allocating your portfolio to different asset classes? And then it was also, they had majority control, because we always tried to get the survey answered by the head of the allocation strategy. So I think it seems like a lot of people are kind of like on the sideline, still waiting. We did see that there are specific types of asset allocators that are more likely to invest than others. So a really interesting result was, and this was statistically significant that we did regression analysis with, was that the more allocation the investor had to bonds, the less likely they were to invest in digital assets.
Interesting. So what's the correlation there?
Well, I mean, this is only speculation on my part, but I think that it has to fit in with the ethos of the crypto industry, which is that, bonds have always been kind of thought of as this safe haven asset.
Right.
So stock market starts to kind of topple, people, fly into bonds, but, bonds aren't actually that safe if you consider that, the government might not default, but they might just print money in order to be able to pay back that coupon rate. So, and the principal. And so I think that a lot of people that are really trusting in bonds are also the ones that are least likely to question the current monetary system.
Yeah, that makes a lot of sense. So Bitmain was one of your partners on the report. How do the new entrants view mining?
Well, we did have a little bit of interest in private equity investments in mining companies, and in structured products around mining. So basically, the big investors, they don't want to like deal with mining themselves, but they wouldn't mind having exposure to it through some kind, like somebody they trust taking care of the investment for them in a regulated way, where they can report, properly back to their stakeholders. So yeah, it was great to have Bitmain on board. I think Europe, some of the northern regions do have interesting electricity opportunities. And so I think Bitmain, writes a very interesting contribution to this report, basically about how an investor could get started if they wanted to. So yeah, that was an interesting insight, because it is kind of an economies of scale game. It's not really for someone that's a small household. It is really for a big pocketed investor.
Yeah, definitely. So, you mentioned the focus again being on the EU, and regulation being one of the things that may be a barrier to entry. How do you think that the new EU's proposed markets and crypto assets regulation, or MiCA, might affect some of the appetite that you're starting to see blossom in the institutional space going forward?
Well, we didn't ask them about MiCA, because I think that might have been announced a little bit after we finished the survey, but we did discuss the rule from the Financial Action Task Force, and we discussed the the EU's fifth AML directive. And both were a bit concerning. A lot of them didn't really understand the implications fully. And so if they don't understand the implications fully, they're kind of like, I'll wait for somebody else to do it first. And then once somebody else has paid the costs of compliance, I'll just ask that lawyer to do it again for me, kind of thing.
Yeah.
So I think that, overall it was, especially for example, so Liechtenstein is not part of the EU, but it's part of the EEA. So they have to implement everything that the EU does, but I think they have a 12-month window after the EU has to implement it.
Mm-hmm.
Switzerland, outside of the EEA, outside of the EU, doesn't have either, but they have their own version of the fifth AML directive, and they also are regulated by, or they would be complying with the travel rule, like all of the financial action task force.
Sure.
So, the thing is that there's a lot of German investors that want to have bank accounts with Swiss companies or want to invest in Swiss products. And so you really have a lot of international investing going on. And that's really going to be interesting for how these regulations are going to impact them.
Great. So one last question around tax. What do you think the impact of tax rules may have across the region or the countries that you heard from?
Well, I did find out even some interesting information from myself that I did not know. So I always thought that Liechtenstein and Switzerland were kind of like these amazing tax, havens. I've been living in Liechtenstein for the past 5 years, and it is amazing in terms of personal taxation and corporate tax. However, when you actually look at the crypto laws and how the crypto gains are taxed, Germany is actually much better, and so is Austria. If you are holding the digital asset for longer than a year. So if you're a long-term investor, you're holding, you have to pay zero capital gains on any sales of digital assets in Germany and Austria, whereas in Liechtenstein and Switzerland, you have a wealth tax, and the wealth tax is basically charged every single year based on January 1st, whatever the price of your crypto portfolio is. You have to pay between 0.06 and 0.08, it ranges on how wealthy you are, but it could go from 0.01 to 0.08% of your crypto portfolio plus all your other wealth. And that does start to add up quite quickly.
Yeah.
Yeah, and that's every year eating away. So, there are some taxes that are kind of sneaky that a lot of people don't know about, and we document that in the report. Another thing we found that was interesting is that there are taxation benefits for investing in funds instead of holding directly.
Mm.
So, yeah, if you're a short-term trader, you're living in Germany or Austria, and you're in the kind of upper echelon of the progressive tax rate system there, your personal income taxes are above 27%, then you actually have a benefit of not investing directly in crypto, but instead holding on to a fund structure because that has a lower tax rate at the end of the year. So we there's all these like weird tax loopholes that give benefits to, randomly just. So we try to document that, and it was eye-opening for me, really.
Yeah, it is interesting when you take a look at all the different governance regimes, not just regulation, tax as well, capital requirements, different governance that might be placed if you're, holding clients' money, and looking at in the aggregate may potentially have a different picture for you and for an institution than it would seem just on face value. I think that's one of the complexities or one of the nuances that's come out in this report. There's a lot of things to consider.
So many nuances. It's a landmine if you want to really all the different laws and regulations that exist, and a lot of it's still kind of like new territory. Some people don't actually know how to properly handle some of these situations.
Yeah, it's still a feeding frenzy for the attorneys. I imagine it will be for a couple years yet. Demelza, thank you so much for joining us. It was a pleasure to have you, and I encourage everybody to download the report when it's published. When will it be available?
It'll be available on October 20th on Cointelegraph's website under industry reports.
Brilliant. Thanks again.
Thank you, Teana.
With the news of the CFTC's indictment of the Bitmex founder still reverberating across the industry, Stephen Pally from U.S. law firm Anderson Kill joined me this week to share his opinions on how he sees these events unfolding and its impact on the industry. I'm joined again by Stephen Pally, partner at the law firm of Anderson Kill. Stephen, thanks so much for coming back to the show.
My pleasure to be here. Always good to be with you.
Great. So today you're going to help us kind of do a bit of a deep dive into Bitmex versus the CFTC.
Sure.
As most people within the crypto industry will probably already be aware, the Department of Justice recently filed an indictment against the senior executive team at Bitmex, charging that they have been in violation of the U.S. Bank Secrecy Act. And simultaneously, the CFTC also took civil enforcement action against Bitmex, claiming that it had subsidiaries and affiliates in the U.S. and knowingly onboarded U.S. customers or failed to do enough to prevent U.S. customers from onboarding.
That's right.
Okay, so it sounds like in the CFTC's eyes, Bitmex was operating as what it classified as a futures commission merchant, which is a role that falls under the Bank Secrecy Act and the Commodities Exchange Act, which would have required them to register with the CFTC.
That's right.
Okay, so it sounds like the executives that are named are their CEO, Arthur Hayes, their COO, Ben Delo, their CTO, Samuel Reed, and Greg Dwyer, who was their head of business development. And Reed was detained by law enforcement in the US, but was subsequently released on bond. So lots to talk about. So let's start with, can you summarize the course of events and what exactly happened?
Sure.
What the executives are being charged with, and what are the two separate, what's the delineation between the civil proceedings and the criminal?
Sure. Well, let's start with sort of big picture, particularly for those who aren't in the U.S. and don't understand how U.S. laws work. You've got two different things that have happened. One is the Commodities Futures Trading Commission is a U.S. agency responsible for commodities futures trading broadly, and enforcing and regulating things that are covered by the U.S. Commodities Exchange Act, which generally speaking, and I'm summarizing, deals with derivatives, futures, things of that nature. And so, and there's some enforcement jurisdiction over spot markets, but only when the spot market trading involves fraud and manipulation that might impact futures markets. So that's the CFTC. And what they can do is, if they see something that appears to have violated the laws that they're charged with enforcing, they can undertake a formal investigation, which is something that doesn't involve a court filing. It might involve, probably would involve a subpoena, document requests, formal interviews under oath, depositions, and then they make a decision whether or not they're going to pursue litigation in court if they can't resolve charges privately. And it appears that what happened here was that the CFTC commenced an investigation of HDR Global Trading, a bunch of companies that we can refer to, generally speaking, as Bitmex, and included in their investigation Arthur Hayes, Ben Delo, and Samuel Reed. And I'm going to take a look at the summary in the lawsuit that was filed. And the CFTC says that Bitmex is, says that it's one of the largest crypto derivatives platforms in the world with billions of dollars of trading each day. And the problem is, from the CFTC's perspective, is that a lot of this derives from access to the United States and to U.S. customers. And they mention I want to say 85,000 customers or customer contacts within the United States. And they're trading things that fit within the rubric of they were offering leveraged retail commodity transactions, futures, options, and swaps, and operating as an unregistered futures commissions merchant. All of these things which required registration with the CFTC, and that is violates doing that without complying with CFTC regulations, without registering as required by the Commodities Exchange Act, which sounds really boring, I realize, subjects you to substantial penalties under US law. And so that's sort of the nature of the CFTC civil complaint. We can dig more into that. There's another piece of this, which is, I actually don't find it terribly surprising. I know others in the space might have, but in parallel with these civil proceedings, the United States Department of Justice, which is also part of the executive branch in the United States, instituted criminal charges, an indictment, which is a way that you charge people criminally in the United States, against the executive team of Bitmex, charging that they had violated the U.S. Bank Secrecy Act and anti-money laundering, know your customer requirements, and all sorts of compliance obligations that go with that. And as you, I think, pointed out, the CTO, Samuel Reed, was arrested. He was, I believe he was released. All that we can see from the docket was that he appeared before a federal judge on October 1st or 2nd, and the next day documents setting conditions of release were issued that imposed fairly reasonable limitations for someone charged with such serious crimes, a $5 million bond with the requirement of $500,000 in collateral being posted, but no restrictions to staying at home, the ability to move between Massachusetts, New York, and Wisconsin, no requirement that any sort of monitoring be worn, which leads one to suspect, and again, this is pure surmise, I have no, if I had inside information about this, we wouldn't be talking, right? But does lead one to suspect that maybe he's worked out a deal. The last time I checked, and I will confess I didn't check today, I'll check in a second. As far as I know, the other defendants remain at large. Let's check right now, shall we? So that's basically that's the nuts and bolts of it.
So, you know, in traditional finance and certainly in other cases that we've seen in the crypto space, having a regulator assess, you know, fines or penalties in a civil proceeding is one thing. It's not often that we see, you know, people arrested and criminal charges brought. So how serious is this, Stephen?
I mean, it's as serious as a heart attack. It's the allegations are of significant and ongoing violations of the Bank Secrecy Act, a statute that has criminal penalties of up to 5 years imprisonment for each violation. I don't see any appearance by Mr. Hayes or Mr. Dilo or Mr. Dwyer in the criminal case, so it would appear that they are still at large. You know, they cite significant detail about the violations. Basically, the Bank Secrecy Act is designed, it comes out of, it refers to a set of laws that were first passed and put into law in the early 1970s as a response to organized crime, right? And I'm like, I'm oversimplifying greatly, but they're designed to, in the case of crypto in particular, to, upon amendment by the Patriot Act to, I'm quoting from the indictment, prevent, detect, and prosecute international money laundering and the financing of terrorism, which is something that the United States government takes very, very seriously. And there was a parallel statement issued by Treasury either on October 1st or September, the last day of September, it was the 30th or 31st, I don't remember, that we'll talk about in a little bit that kind of dovetails with this. Basically, if you are someone who was required under US law to comply with the Bank Secrecy Act and you don't, particularly if there's a view that you are directly or indirectly participating in international terrorism, drug trafficking, the Department of Treasury, the United States government, through FinCEN and through the DOJ, they're going to come after you hard. And that's what they did here.
Do you have perhaps a real world example of a similar case or scenario, maybe outside the crypto world, that resolved, and what the outcomes of those would be? So essentially, we're at the beginning of this. What potentially could we expect to see happen? What's happened to others in the past?
My expectation is there have been some crypto cases that involve this. My expectation is based on, drawing from other examples, and particularly given the fact that this has been going on, according to the indictment, since 2014.
No.
And from at least 2017 or 18, Bitmex knew that they were dealing with U.S. persons and that they were required to comply with the BSA, and they didn't. They moved to the Seychelles for the stated reasons that it would be easier to bribe people there. My expectation is that, my back of the envelope guess is that eventually the executive team will be extradited to the United States and will do prison time. There's been a significant flight of capital from Bitmex. I think they're down 30%. Certainly no interest in causing panic, and I don't have crypto holdings, so this doesn't affect me personally. I would be surprised if that exchange exists in a year or two. Like, why would you put your crypto at risk in an exchange that is subject to where the principals are being prosecuted by U.S. prosecutors, and where the CFTC has come down against them and is seeking disgorgement of profits, is seeking all sorts of monetary penalties? It doesn't make any sense to me. So short answer is prison.
Okay, so that's the maximum. That's the maximum penalty, imprisonment, and you're talking about 5 years for every violation. Is every violation down to a transaction or down to a customer? How do they determine how many violations
per transaction?
Per transaction. Okay.
Right, and I think I saw the number 85,000 somewhere. I think it was in the CFTC complaint. So if you credit that, here, let's see if I can find it. 85. There we go. Yes. So according to the CFTC, during the relevant period, Bitmex conducted trillions of dollars in digital asset derivatives transactions, notional, of course, and it earned fees worth more than $1 billion in transactions on its platform. Bitmex, operated its trading platform in large part from the United States and engaged in transactions with thousands of U.S. persons. Bitmex accepted Bitcoin deposits worth more than $11 billion from at least 85,000 user accounts with a U.S. nexus. So in theory, each of those, let's just use 85,000 and assume there was just one transaction to each account. In theory, you're looking at 500,000 years of prison time. Obviously, it doesn't work like that. My guess is 5 to 10, which gives the CTO a significant reason to cut a deal. And what's interesting, too, is because there was a civil investigation by the CFTC, it appears from looking at the documents, the CFTC got a significant amount of information from Bitmex, internal emails, interviews, and I'm sure they just turned that over to the DOJ.
Yeah.
So we saw the same thing. It's different because with Telegram and Kik, there were no criminal charges. Those are registration cases, nothing to do with BSA or AML KYC. But in those cases too, when the SEC filed suit, they already had a significant volume of information
Well,
that they
how
had
does this
received from the
compare to
target.
something like Bitfinex and all of the legal activity that's been they've been going through over the past couple of years?
It sure seems similar, doesn't it?
Mm. Yeah, well, I think what some in the market may say that Bitmex was headed in this direction, and that potentially leaning on the fact that they were only taking deposits and paying out crypto to crypto, that potentially it was beyond the scope of AML requirements.
That hasn't been the case since at least, like, the regulatory guidance has been fairly clear on this for the last 7 or 8 years. FinCEN has been pretty clear that the fact that you are trading crypto for crypto does not take you out of the scope of the Bank Secrecy Act. It hasn't been a good argument for a very long time.
Yeah. So, is this, in your opinion, just simply a case of hubris?
Yes.
Or, does Bitmex have a case to defend here?
Well, look, I mean, there's always a defense. But what was the line about coconuts? Do you know what I'm talking about?
Yes, I do.
I mean, the guy, these people,
The Seychelles were a more friendly jurisdiction for Bitmex because it costs less to bribe the Seychelles authorities just a coconut.
Yeah, than it would cost to bribe regulators in the United States and elsewhere.
Yeah.
There was the Lambos at Consensus 2 years ago. I believe they had U.S. offices at various points. There was an email where they said, we need to give this guy access because even though he's in the U.S., he's a whale. I think there was I'm looking at, so before I was a lawyer, I was getting a PhD in literature. So I look at things from the standpoint of narrative, right? Like the narrative here, if you will, is people got really rich in a very fortuitous, and let's accept that it was smart. It was like a good bet, but they got something not exactly from nothing. I won't say that. It required patience and in some instances significant technical understanding and maybe mining, but they managed to make just absolutely a crazy amount of money in an unbelievable way. And I think that made some people think that they could fly really close to the sun, right?
So last week, the FCA actually issued a new regulation banning the sale, marketing, and distribution of crypto derivatives to retail customers. It was a pretty bold move. And, looking at this derivatives action being taken, is it the derivatives themselves that are causing regulators worry, or is it really the AML KYC thing, or is it a combination of the both?
It's both, yeah. So basically, Bitmex got in trouble, and its principals got in trouble for both. They were selling certain types of derivatives to U.S. persons without being properly registered.
Yeah.
And at the same time, because they were an FCM, they had to register as a money servicing business with FinCEN and do things like file SARs, have a compliance program. So that led to criminal problems. It's not like, and I would say this, I don't think, it's not that the regulators have a problem with crypto, qua crypto. It's just that, if you're going to sell certain types of commodity contracts in the United States, we have laws that apply. And if you're going to engage in certain types of financial transactions and act as a money transmitter, and the definition of that is pretty clear under the U.S. law, and FinCEN has been clear about its role and the application of the statute to those activities since I think at least 2013, if not earlier. You have to comply, and you don't get a pass because it's Bitcoin. You just don't.
Yeah. Well, you referenced earlier that there was capital flight from Bitmex.
Yeah.
And then looking at things like the FCA ban, which many people have argued that if you aren't able to license firms to distribute these types of instruments to retail investors, they will go elsewhere to find them. And so, that capital that took flight from Bitmex is going to end up somewhere else. Should the executives of those offshore derivatives exchanges be worried? And is this the type of activity that we can expect to see continue, or is this Bitmex being kind of made an example of?
I don't know about. I mean, maybe they're being made an example of. I guess I would say it's a good time to get your house in order if you're offshore and maybe you've had contact with the United States in the past, and not for malevolent reasons, just because maybe you were sloppy. It's a good time to evaluate that and come up with a compliance plan, whether it's backwards looking or forwards looking. And in some cases, it's better to go to the regulator before they come to you. And I think maybe, I don't know how Bitmex handled that, but apparently however they handled it was not the right way. Otherwise it wouldn't be criminal charges. But it's, there are ways to work these things out. And that's the answer. And, the other answer is don't sell certain things into the US. Like I mentioned, contracts for difference. Generally speaking, unless you're dealing with someone who, people who fit into the rubric of an eligible contract party, if you're selling these things to regular old consumers, and you're selling into the US, and eventually there's a good chance, particularly if you scale and people notice, you can get in trouble. So that's not a normative statement. That's just the simple country lawyer pointing out what I think is the obvious.
Stephen Pelley, you are anything but a simple country lawyer, but you are a dear friend, and thank you so much for joining me today and breaking this down for us. It's been a pleasure to see you.
Always a pleasure. Thank you.
Brilliant. You've been watching Coinscrum Markets. Thanks for joining us. See you next week.